evening, everyone, and welcome to this month's Blue Bindi session. Before we begin, I would like to say something that we have already completed 11 expert sessions in this year. We started in Jan, and this is going to be the 12th session for the year. Each focused on helping women understand money better, get them to ask better questions, and make them more confident to take their own financial decisions. It's been a rewarding journey, sharing and learning and growing this together. And honestly, this is just the beginning, obviously, and we're not even halfway there. And as we move closer to 2026, we are even more committed to bringing you many more clear, practical, and insightful conversations. Because financial confidence, it cannot be built overnight, right? And not just with one or couple of or 12 sessions. We need to do this more often. We need to grow together. We need to learn together. So now coming to today's topic, okay, as we head towards 2026, here's the reality. And this is something we've understood, from whatever, sessions we've done, whatever study we've done, whatever we are trying to understand with Blue Bindi program, that most women are doing their best with money. Okay. But many are still unsure if they are doing the right things. Okay. So, there is data that we have to, sort of talk about that women in India earn less in over their lifetime, yet they live 6 to 8 years longer than men. So obviously we need to build better corpus for ourselves, and we need to invest and multiply and make compounding come into effect, get more money for us. And less than 30% of women actively invest in market linked products on their own. So we know women save, but is that money actually growing, multiplying itself? So no, we don't take a lot of risk. We try to keep it very traditional, low key. So that is again somewhere something that is holding us back. And despite being strong savers, many women still keep most of their money in low growth options. And these are all stats that are available, and that's something we've understood. This is happening, and that's the reason we are here today. And we've been doing these sessions over the past 12 months. Okay. So one thing that we understood, the intent, the thing to invest to grow their money is there. The gap is somewhere in clarity and confidence to where do I invest, what do I do, what is the right thing, what is the right approach, and how do I go about mapping that. And today, that's something we are planning to do. There are some myths that we came across while interacting with a lot of people. And then even we were thinking twice that, okay, is this the case? No, that's clearly not the case. So we've listed down some 12 myths that we will have our expert debunk for all of us today and give you all a little more confidence, a little more clarity, and, get you to take the right decisions or right moves and get you better in 2026 with respect to your investments and your financial understanding, financial knowledge. So before we dive into the session where we debunk the myths and plan way forward, I would again like to call upon Mr. Moin to, who can help us warm up this, like wo hota na pre-workout session. So I can hear my, sorry. Is there an echo?
Hi,
Am I
Ritika, am I audible?
Yeah, you're audible, but there was some echo. It's better now. Sorry. Okay, Moin is already here. So over to you, Moin.
Hold on, I cannot hear you, Ritika. Just give us a minute. Hello?
Am I audible now? Hello?
Yes, we can hear you now.
Okay.
Am I audible?
Yes, just a quick one. I was audible so far, guys, the audience.
Yes, we could hear you.
Okay. Okay,
So,
great. Okay.
So thank you so much. Rightly said, 11 successful sessions done. That also makes me think that 11 fun sessions done. 11 times that we've made our audiences think ये सही है या ये सही है, what do I actually do? Oh, ये right है या ये right है? Oh, then I remember, oh, Ritika says all of the above. So so a lot of fun had, a lot of knowledge gained. So thank you to the audience from my end as well for being a part of the fun bit. We are back once again with the last one for the year. We've kept it very simple, just simple 5 questions. Again, no right and wrong answers. On your screens, one by one. Let's go. Okay, so we have poll number 1, which is on your screens. Second, it's loading up. So what gives real financial security? Is it the feeling of being taken care of or being legally named on assets and investment portfolios? So अगर मेरे नाम पे ये घर और ये जायदाद है, only then do you feel that real financial security, or is it just the fact that, okay, I'm taken care of and I feel financially secure? So tell me your answers. I'm punching mine, you punch in yours. Let's wait for a couple of seconds. And let's see the answers.
I think it's the 12th episode, I'm saying 12th session. And still, I don't have all of the above options. I don't know when is that coming into, because I feel I want both. I want.
Okay, maybe next year to try harder, we'll have the third option as well. Okay, so here
Okay.
are the answers on the screen. Okay, so 70% of you feel that just being taken care of also gives you a lot of financial security. Well, fair enough. Nobody is right and wrong here. While 30% of you feel that, हाँ भाई मेरे नाम पे क्या है बताइए, कहाँ है मेरी जायदाद जो मेरे नाम पे है, वो बताइए, फिर आगे बात करेंगे financial security की. All right, fair. Let's have a look at the next one. And we have it on our screen. Who should worry more about money? Which should it be the one who's earning it or the one depending on it? So should the one who's earning it be thinking, कि am I earning enough? मैं ज्यादा तो कोई नहीं एक्चुअली सोचता मैं ज्यादा पैसे कमा रहा हूँ, मैं कम तो नहीं कमा रहा हूँ, क्या मैं इससे ज्यादा का हकदार हूँ? और इज इट द वन हु इज डिपेंडिंग ऑन इट कि यार मतलब ठीक है कहीं ना कहीं से तो आ रहा है. Okay, so quickly punch your answers. I've punched mine, I've hit submit. And
I want both.
You won't get both. You have to pick one. So, okay, so 80% of the audiences feels that the one who's earning it should be the one worrying more about money. Very interesting set of audience. The one depending on it, only 20% of the audiences feel like, why should we worry? यार ठीक है यार, जो पैसे कमा रहा है वो देख लेगा. ठीक है. Stress-free life. Very good. Oh, we have the third one already on the screen. Where does financial comfort actually come from? Does it come from trust within the family, or it comes from legal ownership and access? And by access here, we mean financial access. So is it that the fact that you're surrounded by trustworthy people within your family, does that give you financial comfort, or is it that, you know, जब तक हमारे नाम पर कुछ नहीं है, तब तक वो financial comfort, वो relaxation in the mind नहीं आएगा? Okay, थोड़ा सा thinking, and Ritika doesn't get a third option, which is both of the above. So pick one.
I gave up.
No, two more answers to go. You may get all of the above in the next one, maybe. Okay,
Great.
so we've punched the answer, and I hope you all have punched yours. Whoa, very close call. Okay, so 44% believe that being surrounded by trustworthy people within the family actually gives you a lot of financial comfort, and 56% still feel that legal ownership here. So let's, oh, somebody just changed their answer and now it is exactly 50%. Okay, there is a tie. Okay. Our expert has made a note of it. Moving on to the next one. Let's see the next question. And it says that which feels more risky? Is it the market risk? Is it, you know, the volatility of the market? Or is it financial dependence? The fact that you are financially dependent on somebody. What is more risky in today's world? What do you feel? Is it the fact that ठीक है मार्केट में बहुत वॉलेटिलिटी है, मेरा पूरा पोर्टफोलियो हिला हुआ है? इज इट दैट? या फिर ज्यादा रिस्की वो है कि यार मैं किसी पे डिपेंडेंट हूँ, मैं किसी का या किसी की डिपेंडेंट हूँ, मेरा खुद का कोई फाइनेंशियल एक्सेस नहीं है, कोई इनकम का जरिया नहीं है? ओके, लेट्स punch the answer. And as expected, 70% of you believe that financial dependence actually feels very, very more risky than just those market risks. All right, with that, we move on to the next one. I think the last one for this session, and it's up on your screen. What would you choose today? Peace of mind with capital protection, let's say FDs, which are very, very safe and secure investment options, or volatility with higher return potential, like equities. Which one would you choose today? And we're not asking why, but just if you had to choose between the two, unlike Ritika, who would again here want an option
Both.
which says both. So, okay, pick one. For now, maybe portfolio diversify करने के लिए आप दोनों भी रख सकते हो. So pick one and hit submit. And the response is that 60% of you believe that higher return potential equities ka jo hota hai, and somebody again changed their answer. It's 50-50 now. So with that interesting set of questions and answers, we come to an end of the fun session today. Over to Ritika and our expert for the evening. And thank you for being a great audience. We'll see you on the other side. Thank you so much.
Thank you so much, Mohan. Thank you. And I am very hopeful next year I will surely bring both, all of the above, all those options in place. Myself and for the audience. Okay,
Sure.
now let's dive into the session and let's get Selish on screen. Hi, Selish. Welcome once again. And today we are gonna throw a lot of myths on the screen, and we would want you to debunk those for our audience, because a lot of them, when I was also reading, even I had a couple of questions in my mind, which obviously I'm going to ask you during the session. But that's the plan for today, and let's get going. And yes, as I had mentioned earlier, we'll have sort of, we've shortlisted 12. We had received, or we had more than 20-25 which were there, so we'll try and cover those later. But for today, as this is going to be the 12th session, we thought let's keep 12 myths that we will get Selish to debunk for us today. Okay, so
thanks Ritika for having me, and really delighted to be part of this team. We're taking all the efforts, to empower, especially the women in this field, people, who are low on confidence, or, think, that they need more hand holding, to start the investment journey. I think Blue Bindi has done a fantastic job, in this regard. So wish you, many more sessions like this. Wish you all the best. Season's greetings, by the way, to everyone. We're in the festival mood. I think we are approaching Christmas. There is a lot of festivity around. So on that note, let's start the session.
Thank you, Selish. So yes, so let's see the myths that we have. Okay, let's move forward. Okay, interesting one. SIP is an investment, not a goal-based planning tool. Yeah, it's a myth only now that I've put that on screen, but I would want you, because a lot of interactions that we had around SIP, this was there. It's just an investment and you can't plan it keeping any specific goals in mind. So what's your take, Selish?
So if you look at it, a lot of people confuse SIPs with investments. Whereas the fact is that SIP is one style of investing. It's a way you execute your investment plan. So when it comes to mutual funds, you have, you can either choose a lump sum. So suppose you have 1,20,000 to invest, you can put that entire money in one go, or you can stagger it. But if you want to do it little more structured way, you can do 10,000 rupees a month. That is known as the SIP. So it's a style, or it's a way in which you invest in mutual funds. But it's a tool that is very very useful to build your portfolio for a particular goal. So if you are planning for your children's education or the marriage, your retirement portfolio, or any other short term, medium term goal, then you need to you start an SIP for that particular goal. So suppose I want to buy a car after 5 years and I want to keep aside 10,000 rupees. So I can start a SIP in a, say, a balance advantage fund, and keep on putting that money for the next 5 years. So till my goal actually is achieved. So I'll continue doing that. So that's the way of investing into a mutual fund through the SIP route. So that is what SIP is all about. So it's a
Gets you
goal-based planning tool.
gets you the right habit in a way. If you
Right.
would do it otherwise, you might miss it. It's the, you know, habit that you bring in with for your investments, for your money to grow.
Exactly.
Okay. So the next one is, if markets are high, I should pause my SIP and wait for corrections. So high, or maybe here it would be a lot volatile or something, then should one pause their SIP and then wait for the correction to come in?
Yes, this is a very often asked question, and a lot of people actually act. So what they do is they actually go ahead and pause the SIP if the markets reach a very high level. And when typically we see that whenever the markets reach a high level, they struggle to move further high, and that results in volatility, and that's very natural to markets. So they don't keep. It's not a linear journey that they'll keep going up in a very smooth fashion. It moves up, but it moves up with a lot of volatility. But that curve is upward, sloping. If very often people get unnerved, by the volatility, and then they think that if the markets were to correct from here, or if the market were to fall sharply from there, because they anticipate that happening because of the volatility, they think that let me pause my SIP because my future investments could be at risk, or my future investments may lose their value sharply. Now, this is a myth, because like I said in the previous myth, that your SIP is linked to a goal, or ideally it should be linked to a goal, and you should continue SIP till the goal is reached. So the increase in SIP or the continuation of the SIP should be linked to your goal. It should not be linked to the mood of the markets. That is how I would like to de-link this. So once your goal is achieved, you should stop your SIP. Till the goal is not achieved, you should continue your SIP. Okay, but don't.
Irrespective of the market movement, just continue, because there'll be times, it'll be low. So the average out effect that comes in, right? Most of the times. So high, low, whatever, just continue and focus on the goal, as you rightly said.
Yes, and you know what? As an investor, if you're looking at the markets and taking a decision to either pause or resume your SIP, it means you're timing the market, and that is
Yeah.
what SIPs take away. Basically, if the SIP was designed to help people avoid market timing, so that you're not, because whenever all this is driven by emotion, because you are fearful, or sometimes you're greedy. These are two dominant emotions in the equity investing. And because you're fearful that the market will fall, you think that I should pause my SIP, and people go ahead and do that. But that is not the case. You should continue till the time you want to, your goal is achieved. And because you should not time the market, because it is futile to time the market. That is why the SIP was, suggested for investing, particularly for any goal.
Okay. Okay, moving to the next one. If a product earns me a little profit, I should exit immediately.
Okay. Now this is very interesting. If you look at it, suppose you uh, invested in two funds. Okay, fund A and fund B, and fund A, is growing very fast and is making profit. Fund two is growing very slow, and you get frustrated looking, because now you think that oh, I should have invested. Why did I start my SIP, say, in a fund B, and I should have been in fund A? And that you try to, do your mental calculation saying, if I was in fund A, then I would have made so much so
Money.
extra profit. Okay. So basically, that is how it works, psychologically. Now, uh, when it comes to, booking profits, or you think that the markets have reached a high, or you think that there is a time to balance your asset allocation, people typically, if you want to balance the portfolio, they will try to sell something that is making a profit, because there people, you know are happy because they've already made a money. Suppose they invested 1 lakh rupee and it's become 1,20,000. So they don't, feel that they're, to take out money 20,000 rupees. But suppose they invested 1 lakh and that has not grown it. Suppose it is at 99,000. They will not like to exit that fund which is at 99. Now, whenever you decide to exit to rebalance a portfolio, you should look at the laggards or something that is pulling down your portfolio performance. So if there is a, for example, in this case, fund A was doing well and fund B is not doing well. So you should revisit the hypothesis. You should look at the B portfolio, whether it is fundamentally wrong, or there is the market is in a situation where it is not allowing the fund B to grow. Okay. If it is temporary, then allow both A and B to continue. But if there is fundamental problem in the B, which is dragging the performance down, then there is a reason to exit that fund. But, don't, it is like, you're cutting down your profit making, investment rather than pulling out the loss making one. So that is how it should be. So if you
Because people
really want to
are hopeful. Sorry, I was saying people
correct.
are hopeful that for 1 lakh, that 99, it might just, pick up and I'll not make loss. And you end up selling where you could have actually made that 1 lakh ka 120, it would have become 150. But you
Right,
just took
right,
out, yeah.
right.
So, okay, the next one is FDs are the safest and always better than equity products.
Now, this comes from, this is something that would be a myth for a very, conservative investor. Okay, because a conservative investor would refrain from, investing into a high risk investment like an equity. Okay, so they would rather like to choose a very, safe investment like an bank FD or a corporate FD, or maybe any fixed income product like a NCD. Okay, because they think that if I put in, say, a 1 lakh rupee, I will continue to get a fixed return, and my 1 lakh rupee is safe because my capital is going to remain intact. But if I go and put that 1 lakh into, say, equity, now there is a risk reward equation there. So I can earn more than what the NCD or the bank FD is giving, but I could also lose my capital. That 1 lakh can become 90,000 also, or it can become 1 lakh 20,000 or 1 lakh 40,000, or even it may grow to 2 lakhs over a period of time. So what we tell investors is to do asset allocation, that both investments, type of investment, whether it is FD or equity, have their role in the portfolio. And, I always explain this with the help of the, a balanced diet that we have. You can't only have proteins in the food or only carbohydrates. You need to have both protein and carbohydrate and fats. So we say that you should have equity, debt, and gold in the portfolio. Each of them have a role to play in the portfolio, and each of them will reward you over a period of time. So none exists, without a reason. And therefore, this is a myth that, because what will happen is FDs will give you, say, 6-7% returns. Equities can give you double. It can give you 12 to 14% returns. So if you want to meet a bigger goal in, in a given period of time, you will have to basically invest in equity. Otherwise, you will risk losing that goal. You might miss that goal, or you may not have adequate money to meet that goal. Therefore, both equity and FDs are required. And that is why, we think that, people who stay away from equities thinking that they are, they are very risky and, they are better off in FDs, are, dealing with the myth.
I know a safer option, but yes, as you rightly said, for earlier thing also, if you have a goal in mind, it's better to sit with somebody who understands and do the asset allocation correctly, because that's how your money will grow and that's how
Correct.
you will make the most of compounding.
Correct.
Okay, next one. Okay. Gold investing. Oh, yes. This is something I think even in my family, even I have debated with my mom that gold investing is equal to buying jewelry.
So, let's talk of gold first. This has been the year for gold. In the last 2 years, gold has done, fabulously well. I'm sure all the women who bought gold and they are part of this discussion would be really, really, patting their back and, claiming all the credit for making that right decision. Yes, gold has been the best performing asset class, even better than your equity. In fact, equity has disappointed. So all those people who did not invest in gold or invested a very small amount are suffering from FOMO. Okay. And that is also one reason that a lot of people are they're feeling missed out. And of course, to add that, the silver has also done very well. So both gold and silver, both the precious metals have done well. Now, people, if they want to take exposure to gold, they rather, the one thing is they can go to a jewelry shop and buy the jewelry. Okay. But if you're making investment in gold, then there are alternatives available today. You can choose to invest in gold exchange traded funds, ETFs. These are like your mutual funds. These mutual funds buy gold and they give you units. So it's a digital form of gold. You don't physically end up owning the gold, but the value of your fund is, moving up and down in relation to the gold price. Okay. So from, from even from a physical storage point of view or, safekeeping, gold ETFs are the best form of investing rather than buying a jewelry, because jewelry, of course, will have, GST taxes and it may not be the purest form of gold in that sense. But when you buy a gold fund, it becomes, or a gold ETF, it's the most purest form of gold that the mutual funds buy. And there is a, you don't have to worry about the safekeeping and all. So if you're investing in gold, then, just because you bought a jewelry doesn't mean that you invested in gold. You have to replace it with an investment product like a ETF, or maybe, earlier you had sovereign gold bonds also, which are no longer available.
No, so that's what I think. And my home, we've come to consensus to not, because as you rightly said, in India, and if you're considering gold, and again, the way you said that ETF would be a digital form of it. Till the time people actually see it, hold it in their hands, you don't
Actually,
get the feeling that you own it. So if you're
yes,
not buying jewelry, at least you've moved into, investing with those coins. At least you're saving, the way you said GST or charges and all. Not GST, obviously you pay that if you need the bill, but at least you're saving on the making charges and it's the pure form, right? So that's the next step that we've moved to. So yeah. Okay, the next one.
gold never
Gold never
falls.
falls. It's always the safest for women. Yeah.
Yes, if you look at it, if I have to speak purely in the context of India, okay, we Indians have always had a fancy for gold. We have, always had love for this asset class, and it has not disappointed. So even if you go and ask your parents, grandparents, have they suffered a loss in their gold investment? No. Okay. Uh, but if you look at the returns, minus the latest returns, maybe after the COVID is when the gold started doing very well. Before that, gold was, generating 6 to 7% returns. Typically, gold returns are linked to inflation, meaning, it's a little technical. So whenever we say inflation of 6%, it means your currency is losing value to the extent of 6%. Okay. So, so if I have 100 rupees, and I want to buy something after a year, that thing will cost me 106 rupees. So, my money, the currency note that I have, is still worth 100 rupees. but the product that I want to buy after a year may cost me 106. That means the value of my that 100 rupee in my hand is now gone down because it is not worth, I cannot buy the same thing with that money. Now, if I had purchased gold, that gold would have gone up from 100 rupees to 106 rupees because it keeps pace with inflation. Therefore, it is also known as an hedge against inflation. Okay. So in the past, gold returns have also faltered. So whenever, if like I said, I'm talking of India as a market, we don't sell gold and we don't buy gold from an investment perspective. It is just that I feel very secure. Like, Ritika, you mentioned that you kind of have that confidence. You have a tangible asset in front of you and you gives you that feeling of security, whether it is lying in the locker or in your safe at home, you feel more confident. Okay. And that is why Indians have never sold gold or they've never traded in gold. Unlike the Western markets or the developed markets where people buy equity, sell gold, or they sell equity and they will go and buy gold. Okay, so they will replace those assets in their portfolio and therefore they trade in gold and therefore the prices of gold move up and down. Because we don't trade, we buy and hold it forever. In fact, it is considered inauspicious in India to go and sell gold because typically, you have people like to trade in gold only when they are in dire state or their financial condition is very, very in a very bad position. They would like to go and sell gold. That is changing now. People are trying to understand how the gold prices move and they want to make profit out of it. Yeah, but it is not that the gold has never, the gold prices have not corrected. In fact, if you look at it, I remember on 17th October, gold hit the first time it hit the all-time high. It, it almost touched 1,30,000 rupees for 10 grams. And then it fell to 1,20,000 rupees. So did the gold price fall? Of course it fell. But if you had bought it and your jewelry and you would not really look at it whether it is 1,30,000 or 1,20,000. But in practical sense, the gold prices do fall. Okay. And they have been in the past history, the gold prices have not moved for 30 years. But they've been, completely flat. All those who have gone through that phase will tell you, how much of a, disappointment it would be for them to hold gold for such a long period. You and me will get frustrated with equity. But, just imagine people have lived through that period also.
But I agree that in early times it was still about safety because again, parents would give it to their daughters. That was the mentality or that was the way people would look at this asset class. That was the point the safety thing came. And I think because you would get married and you would get that gold and that will be yours. So, from that perspective, I think it was there. But now, yes, people have understood. And I've seen, people obviously during Diwali also, Dhanteras also, I've seen people investing in gold ETFs as an option. But yes, again, a limited amount will still go because Indians, they would want to see value something in hand. So, yeah. But yeah,
Correct.
It does fall. The value does fall. Okay, next one. Oh my God, the next favorite is real estate. And that is something that people feel or, it always appreciates. And that is equal to guaranteed creation of wealth.
Yes, I think again, with respect to real estate, also a lot of people have the same notion that they have with gold. Now, gold is in short supply because, you have to mine gold and, and it takes a lot of effort to, find gold also, and it's not easily available. Similarly, thing happens with real estate. The land that God gave us is limited on this planet. Okay, we can't create land. Of course, we have gone and reclaimed the sea. Okay, that becomes extra land for us. But the natural land is the whatever was gifted to us by God. So land is not easily available. And wherever we have built buildings, we have built, and we are only going up. We are not able to spread, especially for people living in Bombay, they will agree. Now we have, in residential areas also, we have got long towers coming with 20, 30, 40 story, 50 story towers coming into India. And, there has been a big boom in the real estate space. that has also given a lot of overconfidence to people that the real estate prices are likely to go up and they don't never come down. But if you look at it in the last 10 years, I think from 2010 to 2020, real estate prices were literally flat. Okay, and I think that property appreciation in general terms was not more than 5%. Yes, you will find some pockets, where you will the land is not easily available. Those could be premium location in your city. So you go to Bangalore, you go to Delhi, Gurgaon, Mumbai. Certain premium locations is where the property prices would have not really, fallen, but they would have not really also appreciated. So there are some pockets, but even if you look at certain places, say for a Gurgaon, which is the most talked about place in India, and how it has come up, there are a lot of pockets where the property prices are not appreciated. So real estate always appreciates is not guaranteed. Okay, which project you choose, which locality you choose, how it develops over a period of time is important, and therefore you will you get your real worth of your property. But you will buy your property anywhere and you expect that it will appreciate is not going to happen. Of course, you have to do your homework very well, but real estate can also give you a very meager returns.
And now with the kind of rates we see, I don't know, it gets very even more difficult to actually go out and purchase something, right? And then
Absolutely.
wait for it to appreciate is something, I mean, long drawn thought. So yes, instead you have better options already available. So why not invest there, and why not expose yourself to those? Then wait for this. Yes. So the
Exactly.
next one. Okay. Equity investing is equal to stock picking, and mutual funds are just as risky as stocks. Oh my God, we have everything around equity in this.
So this covers two myths, in fact. When it comes to equity investing, people think that the best way is to pick up a stock. So you have a lot of tips and recommendations, going around on various social media channels, influencers talking about it. Certain companies which have really grown 5x, 10x in 1 year, and obviously for the uninitiated or the people who are very new to equity investing, they get carried away. And one, it creates FOMO that they are not part of that crowd. And second is, sometimes, they just fall for the tips, and they don't realize that, they may be getting into a trap. So one is that if you are not a seasoned investor, you're not an experienced investor, you don't understand how equity markets work, then you will have to do little homework. थोड़ा मेहनत करना पड़ेगा to understand how equity market works. Second is stay away from stocks, because even the most experienced investors make a loss in stock picking. So whether it's not very straightforward. Of course, you have to do a lot of study, but mutual funds are a proxy. You can instead of the buying stocks, you can look at equity funds as an alternative. And yes, are they risky? Of course, they are risky because you are investing in equity after all. But are they as risky as stocks? No. You may, as an investor, you may buy 1 to 10, 15, 20 stocks. A mutual fund can own up, in a portfolio 80 stocks. So that there is always a diversification, and therefore that reduces risk. So there is a fund manager who is at the, who is managing the affairs. There is a team of experts who is helping pick up the right stocks, the entry into the stocks, exit from the stock, understanding what is happening in the markets, various external factors that influence the market. Everything is studied, and that is how they navigate the market, which will not be possible for you, and therefore you may end up making a loss in a stock. So I would suggest that yes, equity investing is not equal to stock picking. That is one, and mutual funds are not as risky. They're risky, but they are less risky than the stocks.
Stocks. Yeah. Yeah. Okay. So yes, this I think we did cover in our insurance exclusive session as well, but still exists as a myth, because a lot of people think that company health insurance hai or apna bhi wo hai, then you have your spouse's company also at times covering. So that's good enough. So
Okay, I think the people again are mistaken on this front. Yes, today companies provide you that health insurance cover, but I'm not sure how many people actually read the company insurance policies. They think that the company has done the homework. They would have thought about the best interest, and they can continue to move on, which is okay. The companies obviously do their hard work to give you the best insurance plan. Not, but having said that, if you move out of that company, or if in case your hospital bill is more than what the company cover is, if it is not adequate, then you need to have a your own insurance policy to support. And of course, you know. Once you move out of the company or you retire, you may not be having a medical insurance cover. And by the time you go and buy your own insurance cover, you may have developed a medical condition. Typically, some lifestyle diseases like blood pressure, diabetes, thyroid are all, can act as a barrier, to, it can insurance companies can come and tell you that these are the disease and we may not give you an health insurance plan. Okay,
Yeah.
so it is better to have your own cover in addition to what your employer is giving. So suppose your employer has given you a 5 lakh cover, you may go and buy another 5 lakh for yourself, or maybe a 10 lakh cover for your family. So it is good that you have a 10 to 15 lakh cover. So and of course you need to have your entire family covered, not only you, because the company can also cover your family, but obviously they will also take that extra premium. So if you're trying to save premium, it will the extra cover will come at a cost.
I think, yeah, that's we talked about it in our insurance bit. So yes, it is. And in the world we are living in, we absolutely need that, the way
Absolutely.
the costs are increasing, the medical cost, and the way our lifestyle has become. So I think it's a no-brainer for all of us now. Yeah, the next one is, so this is again a thing that term insurance is waste of money. If nothing happens to me, then it's all gone.
Yes, now this is a very popular objection which people have when they buy a term insurance. So term insurance is in a simple word, is the most simplest form of insurance. It's a real insurance product where it only covers the risk on your life. Okay, if something happens to the person who is covered, only in that case, yeah, the insurance company will pay the claim. If the person survives the premium period or the life of the policy, tenure of the policy, then he doesn't get anything. So if the policy is taken from say age of 30 to 60 and it's a 2 crore cover, and the person has been paying say 20,000 rupees every year for this policy for the next 30 years, he might feel that yaar kuch mera 20,000 rupees to waste ho rahe hai. Okay. And if he survives that 60-year period and he happily retires, he might feel that, oh, 30 years into 20,000, 60 lakh rupees is what I have paid every year, and that's going kind of gone waste. So people might basically think in that direction, but you have to understand that every day when you have a term insurance, you are feeling relaxed. You have a peace of mind, and that comes at the cost of the premium that you pay. Okay, so basically that is the money that you have paid to buy that peace of mind. And it is also important that from 30 to 60 years, if something happens to you, you may not have the investment product. You may, if suppose it's a 1 crore policy, you may not have that 1 crore with you immediately. In term plan immediately creates an asset for you. So it's the asset generating insurance plan. Okay. So while you may take 10, 15 years to build your 1 crore portfolio. In case something goes wrong with you, your 1 crore is immediately created by the insurance company. That's the beauty of term insurance. And therefore you should not feel that there's a waste of money. And to also, give you a further lowdown on this, insurance companies have now started giving you a plan where you get your premium back. So there's a return of premium, policies also, where at the end of 60 years, suppose you bought that policy, you will get all your premiums back. But of course, it's an expensive policy. and your cover will be less compared to the premium you pay for a pure term plan.
If
But
you're
yes,
sure, if you're sure that you're not going to die at 60, but you still need that peace of mind, you may go for that.
yeah, you may
You
then in
pay the
that case, if
price.
you're damn sure about it, then you may, take that chance of, retaining that 20,000 with you and also retaining the risk.
Okay, the next one. Oh my God. Yes. This also is a thing that people get confused with diversification. That if I have, people keep hearing you need to diversify, you don't put all your eggs in one basket. And then comes this thing that I should have more products that is equal to, better diversification.
I think yes, one thought is that a lot of when we look at portfolios, especially say a mutual fund portfolio, stock portfolios, uh, or even insurance portfolios, I find that people have uh, 40, 50, 60, 70 mutual fund scheme. Not that's over diversification. And people ask me like how many funds should they have in the portfolio? It should not be more than 7, 8. So what is the another extra? Say you have got 50 mutual fund schemes, and if 8 is the upper limit, then what are the 42 extra funds doing in the portfolio? They're doing nothing. Okay, just taking away your time. Okay, and you may feel at ease that, oh, I've got 40 mutual funds. It gives you that one perception or impression that you have a lot of money and you have got 40 mutual fund scheme, but practically they are not playing any role in the portfolio. Okay, so there is over diversification, and you will stop. It will reduce your efficiency to track the portfolio, because all those mutual fund schemes in your portfolio will be demanding attention. And therefore, I think that stick to fewer products, whether it is fixed deposits, whether it is insurance policies, whether it is mutual funds, or whether it is stocks.
That's something people need to clearly understand, because this is something I've come across multiple times. And because now people are talking a lot more about diversification directly, more products is something that people, try to justify that with. So
Yeah,
that
people
understanding.
justify, but people are buying more products because of the marketing gimmick. A lot of
Yeah.
these companies, they come up with NFOs, and every day there is a new product and it has its own characteristic. And I'm, amazed at the way, a fund is projected as the,
Be-
the most important discovery in the market, and how it is the only missing piece in your portfolio, and why you should have it in the portfolio. And only if you are experienced, you can see through it. You'll know that it's just another product in the portfolio which is not going to play any role. But that is how people end up buying more products, and then when they want to justify, they say, oh, I was just trying to spread my risk. But that's not the case.
Absolutely. And we come to the last one. Oh my God, you don't need professional help to manage your investments. I think this is something we've debunked, and we know that our audience also knows in a way, but we still get to hear that okay, there are two things that I get a wealth manager, with the kind of money or investments that I do. And the second thing is I don't need only, I'll just do it by myself. So, that's something that people need to understand. For everything, like if you have a medical condition, you go to a doctor. So, similar way, you need to consider your finances as well, that you need to go to the expert.
Yes, I think with the help of technology, now you can, buy mutual funds or stocks on the mobile phone itself. So people think that, okay, I don't need any human intervention. I don't need to ask anybody. And, there are a lot of recommendation anyway pouring in on social media. So people know, where to look for and why should I pay. So a lot of these research is paid for. If you buy mutual funds through, say, an advisor or a broker, you have to, the NAV would be slightly, it will be, there will be an expense that will be built into the NAV. It will be, compared to a direct mutual fund. Now, I understand, people questioning whether the advisor is adding value. Obviously, you need to go through an advisor who you feel confident is competent to handle your portfolio. That is a required. But I think that doesn't take away the importance of an advisor. Like you have a doctor, and if you have you have a fever, you might do your first aid, and you might take your tablet, Crocin or something, and you might feel better, and you might feel that, oh, I don't need a doctor. But it could be seriously something else in which you mistake in it as a fever, and there you need that expert intervention. And similar case is with investment. Like we've been talking about 12 myths, and you mentioned that there are many more which came to you where people were asking about it. So just imagine if you are a DIY investor, do it yourself investor, and you're dealing with so many myths, and you're carrying your own biases, your portfolio could be suffering. I mean, you could be building a very inefficient portfolio just because you have certain myths and biases. So, choose your investment advisor. But yes, you have to be wise to choose the right investment advisor. He has to be competent to handle your portfolio also.
Absolutely. So yeah, as I told you, Shailesh, there were more, but yes, we shortlisted these 12 and we wanted to focus on these. And I hope these, what you spoke of, what information you shared, at least if we were all, some of us were thinking that these are myths and are not taking any action, or now with what you've shared, what we discussed, I hope that we were able to debunk and we could put the fact across. Now we'll do a quick, this myth piece we spoke of, we're done with. It's not a, we mentioned this about in our promotions also, that there'll be a quick money confidence check that we would want to do. It's not a test or anything. It's just a mirror that we want to show, so we'll put across some questions, okay, on the screen. And so if you read these, that if you think that about that question, that you are confident, you are informed and actively taking those money decisions, you give yourself 2 points. If you think you're still trying, you're still there, you'll be there, but you're somewhat comfortable, somewhat confident, but you still need that little bit more clarity and guidance, then you give yourself 1 point. And if you think, oh my God, I don't know, I just avoid it and I feel stressed about this point, then you give 0 points. So you don't give anything. So if you think you're confident, you're doing it there, you're proactive, you're there, so you will give 2 points. Medium, 1. Low, completely nothing. Stressed out, 0. Okay. So even I'm going to make a note of this. This is, as I mentioned, it's no test, nothing for anybody here who's joined today. It is just to give you guys an idea of where you stand. It's just a, sort of a mirror that will give a reflection of where you stand at what point you are today. And obviously you can get better. You can do way better. So let's get started. So we'll have the questions on the screen. Okay, so the first one, I have started, or I've been increasing my investments with, we could take into account this year, so you started investing and at the same time you started increasing your investments. If you think you are confident there, that's what you've done, you give yourself 2 points. If you think, okay, I did start but I didn't increase, 1. And if nothing, then 0. So let's write it and then let's quickly end, at the end, just total it up. Okay, I hope everybody's with me on this. So first one we are done. I hope you've added your points. Next one is understanding your mutual fund investments. So do you understand? Are you confident enough? And as Shailesh was saying, do you have a lot of funds that you've invested in, or you have few and you've, increasing your SIP amounts, or investing a lot more lump sum there? If you're doing that, give yourself 2 points. If you're not, but you still have a couple of SIPs going on, then you are medium confident, 1 point. If there's nothing, then we go with 0. I have noted mine. Next one is investing in equity for the long term. Okay, so if you did that, if you're doing that, maybe not this year, you did it last year, but obviously it is for the long term. Good enough, 2 points for you.
Ritika, long term over here means 5 years.
Obviously not not for my granddaughter and all of that, but yeah, 5 years. But yes, you've done it this year or last year also, and you're
1 year is
invested.
also short term for equity. So if
Yeah,
anybody is
obviously.
thinking that मैं तो 1 साल के लिए कर चुका हूँ, then you are a trader, short term investor.
Long term 5 years, and you did it last year, but you invested. And the way we were discussing, if the market was volatile, did you get scared? If that made loss, profit, did you exit, whatever? No, but this is for the long term. It's still there in your portfolio, and you invested with that intention. Tracking monthly expenses. Nowadays, so there are so many apps, and your credit cards app also give you, and also your not Paytms, but at least Cred and all I've seen, they give me a clear picture at the month end that this is where you spend, this is what you were doing, this is where you went overboard. So yeah, it is scary, but at least somebody is doing that for me. I don't have to maintain that Excel. So that's happening. So if you are also doing that, keeping a track, please give yourself 2 points. Then knowing your monthly savings. So we've discussed about this also. Once you earn, you invest, you save, and you do your expenses. So, you know where you're putting your money. You know you need to have your 6 months. Salish, what is that? 6 months expenses is something that, we had spoken of that you should be keeping in some.
Putting aside as a contingency.
Yes. So if you are doing that, knowing your monthly savings, perfect. Give yourself 2 points. Next one, planning for retirement or long-term goals. So yes, nowadays, so Salish, at 40, I've seen people ready to retire. That's their goal. So if you guys are doing that, please give yourself, you've started investing, started planning for retirement, 2 points. Not there yet, 0, but you can
You
get
can
started.
retire at 40 only if you plan at 20.
Yeah. Good one. So I'm not sure if all of us started at 20. So maybe 50,
I have
55
another question.
Salish.
What will they do after 40? That is also important.
Oh, people have a lot of plans. We're not even aware about that. So we'll just travel, start there, just chill. And I'm pretty sure people would give me those answers if I asked her. So yeah, we can do a session on that maybe next time. Then handling unexpected expenses. Oh my God, I always try. Obviously, those are unexpected. So वो थोड़ा हो ही जाता है overboard, but ठीक है. Giving myself the point. Asking for better pay or growth. These points we've picked up from, the sessions we did, and, whatever we were discussing throughout the year, that in different sessions we would have spoken about it. In some way or the other, it would have given that confidence, assurance to you that you could do this, you can, do this better. So asking for better pay, asking for better growth opportunities. So if you've done that for yourself, give those 2 points to you. And okay, not the last one. This is the second last one. Making big financial decisions. Being part of, I would also say, if you were part of those discussions with your family, still you give yourself 2 points there. And the last one, talking openly about money. Should give 10 points to that, because yes, with Blue Bindi, that's what we are doing. We get people to talk, to discuss. So if you're doing that, give yourself those 2 points. Now let's just total up everything. We had 1, 2, sorry, go back. 1, 2, 3, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10. Okay, we had 10 questions. I hope you all have given points for those 10. Now let's move to the next slide. Okay, now just total up your score, and then you can see the table on the screen. If you see the range, if the total is between 15 to 20, you are pretty confident you're there. You have a strong money foundation and are ready to take those advanced moves. If the total is between 8 to 14, you're getting there. You are aware, you're willing, you just need a lot more structure and, a lot more confidence and a lot more discussions the way we did today. That will get you there. And if you're still between 0 to 7, you need to start, you need to put in more efforts with, simple small habits, changes that you could do, and all the learnings that you have from our previous sessions. So you can get there. You need that support, or you can reach out to people, around you or to us, and we can guide you there. So if we'll send this out to everybody. If you want to go through it again, take the test again, maybe once you start working on it and see the number changing, get even more confident there. So we will put this across, and you can share it with others as well, to just see where, just for the mirror's sake, where do you stand today? Okay, now Salish, to the last piece. Key takeaway, not just from this session, for the year, anything that you would want to tell the audience that, okay, one message for 2025 and something to look forward to for 2026.
So Ritika, I have on many forums shared, if I have to sum up investments, and based on my experience of dealing with a lot of investors, taking their queries, doing forums like this, having webinars. I think one thing that comes in the way of people, whether it is wealth creation or achieving their goals or feeling confident about the money is, people don't start early. They are, they, by the time they realize it is either it's too late, or they just want to take extra risk and try to achieve their goals. जो समझ में आता है वही करना है. You have to take efforts to understand in various investment products. So if you have to sum up in three sentences, what people need to do is they need to start early. The investment journey has to start early. It should be as early as your start of your career. Okay, from the first salary, you need to start investing. Okay,
Yes.
then is go slowly. Okay, you don't have to rush in. You don't have to buy the mid caps and small caps and 10 mutual funds in one go. Buy one mutual fund, understand, go slowly, build your wealth slowly, and you will reach safely to your destination. So whatever goal you have, treat it as a destination. So for your journey also, like you have to go to the airport, that the boarding will close by 30 minutes before. You need to reach airport 2 hours before. The traffic, you look at the Google map and all. What basically you're trying to say that I want to avoid that last minute rush so that I don't miss my flight. Same applies to your investment journey. You need to start early, go safely. You don't have to worry whether the Uber driver cancels and you're stressed and something goes wrong. Okay, there's traffic on the road, and you're stuck, and you reach safely. You don't really want to reach airport in a time where you're fighting with everybody and struggling to get, fighting with the guards and the ground crew and all those stuff. So start early, go slowly, reach safely is my message for 2025 and for the next year also. I think it lives on forever. You just need to get these things right, and then I'm sure everybody will be a successful investor.
Wow, that was interesting, Salish. And something that is not for a year or so and applicable to everyone, So if you're starting, start now, go slow, and you'll be there. There's no hurry. So today we're not keeping any, Q&A. We already had taken those myths that came in, and we wanted to talk around that. But still, if anybody has any doubt, any question in their mind before the year end, if there's anything, do reach out to us, and we will be happy to answer those questions. So, okay, now coming, this is the the last one, I would say, for the year. We are going to see you all obviously the next year. But yes, thank you everyone for being part of the journey, for showing up month after month and trusting these conversations. Now, as we step into 2026, we hope the year brings a lot of prosperity, confidence, and courage and clarity in all our financial decisions that we take, and obviously with Blue Bindi and with Salish, we're surely going to be doing that. And thank you, Salish, for, being with us for every session and taking those, our questions, our myths, and trying to give clarity and, confidence in for all of us. That is something we really admire. And thank you for, being part of Blue Bindi. So yes, thank you again, everybody, for joining in. That's it from us for this year.
Thank you,
Oh.
Ritika, for allowing me to be part of the Blue Bindi team and sharing my thoughts, my experience, my wisdom with the audience. And I'm sure they are finding this interesting, insightful. Yeah, I would also like to end the year with Merry Christmas and Happy New Year in advance.
Yes. So see you all, guys, to the other side, 2026. Wishing you all a very happy new year in advance and hope you all get your Secret Santa gifts. Okay, bye bye. Signing off. Thank you so much.
Thank you, everybody. Bye.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.